to you guys. Great seeing you all. I'm happy we're here in rain and snow like some of our offices up in northern Wisconsin and Minnesota. They have to bring their snow shovels out. And I'm so happy that that's not us. And I had that packed away. I was telling my wife, I said, if I have to bring that thing out just to shovel or just go snowball snow again, we might call it quits. So I'll throw that thing in the street. But today I wanted to just go over a couple of things with you guys, a couple of things about products that I see that are out there in the market, as well as interest rate outlook, and some of the numbers that we've done so far for us. As of year to date, right now we're almost at $6 million in closings with Macaulay. That translates to almost $24 million a year. 6 million a quarter, 24 a year. So we're basically on pace to what we did last year with Macaulay. I think that over the next quarter two, quarter three, I think the market's going to heat up a lot, and I feel that those numbers are going to be much higher. Average loan amount is about $180,000 right now, and we are averaging about 12 to 14 closings a month. But what is really a strong figure here that I see is our closing ratio, our active closing ratio. So, like I always have discussed in the past meetings, an active closing ratio is when the app comes in, we actually have a purchase agreement, and we're progressing to closing. Our closing ratio on that right now is about a 94%. So in my eyes, what that means is that our retention of the client, whether they're coming here on a strong lead or a cold lead, all right, we're keeping them through the lead process, to the application process, all the way to the closing process, and we don't have that much fallout. So, great job to you guys for referring them over here and, speaking highly of Diamond, and great job to our loan officers for, maintaining that business once we have it. Interest rates. So this morning, Freddie Mac's chief economist came out and predicted that the interest rate market is to stay low throughout the course of the 2019 year. That's primarily due to growth of income and strong home ownership. He doesn't predict that these rates are going to skyrocket like everybody's predicting. But I would estimate, if I was to guess, by fall, maybe 4.6. I mean, current market rate right now is still hovering down the low fours for qualified clients. So, that's about 1% lower than where it was last fall. So, all the home buyers out there that were on the fence last fall and maybe got cut on the purchasing power because of a 1% higher interest rate, now hopefully is able to qualify for that house that they did want because the rates are a little bit lower. A couple of products I see out there that I feel are pretty strong, and these products can be presented at any one of your guys' office meetings. The first one I see out there is the 3% down conventional product. All right, this product is basically a spin-off to FHA's product. It's been out there for a while. Many of you guys and girls have used it before, but just a couple of quick pointers on it. Number one, it does not have to be for a first-time home buyer. Okay, so you can have a client that owns a house right now and still qualify for this 3% down conventional loan. Number two, it's credit score driven, but the adjustments to the interest rate to the buyer is not, they don't take those adjustments. So typically on a 5% conventional loan with a 680 credit score, your interest rate would be slightly higher, okay, than a 720 or 740 borrower. On the Home Ready product is what it's called Fannie Mae Home Ready. Those adjustments are a lot less, and the PMI is a lot lower. So it allows for borrowers to qualify at an easier level. The one thing with it is there is an income cap. Most of us in this area is going to be capped at about $84,600, but there are areas in Lake and Porter County that there is no income cap to it. So, obviously when your clients were reviewing loan products with them, if that product fits them, then we review the property address that they're looking at to see if it is in that income census or not. But yeah, that's one product out there that I see is very strong because it doesn't, if you have a house that needs repairs, peel and paint, utilities aren't on, conventionally, that product can happen. The other two products I see that are pretty strong out there right now is obviously our construction lending product. Offers a very low minimal down payment to your clients. Basically we fund the builders 10% upfront on it, and realtors, you guys get paid at the time of construction on closing. So there's no waiting 6 months, 9 months for that house to be built. Once that construction loan closes, you guys get paid. So the product is a little bit more in depth, but and generally speaking, it's a fantastic source for your clients that are looking to build a new home. The last one is renovation products. I know sometimes these scare everyone because they think they're difficult, they think they're hard, but with the lack of inventory out there right now, and a segment of price ranges, probably less than 225, I'm assuming. There is not a lot of houses that these clients can qualify for. So what they're doing is they're looking at these homes at 120, 130, 140, 150, and seeing what do they need in order to make an offer on this house, right? Sometimes it's the kitchen, sometimes it's the finished basement, sometimes it's just painted carpet. So a lot of times these buyers, instead of waiting for the right house to pop up, they're finding the older home and they're renovating them with either the FHA 203K or the Fannie Mae Advanced style renovation loan. Both of them are fantastic options. Both of them are simple. And the easiest process is make sure you have a contractor go out to the property. If the client's interested, have the contractor go out there with them on the next visit, just so you have a general idea on how much the repairs are going to be, so that we can have the loan put together properly for them. So those three, obviously you still have all the BA, FHA, those are also great products. That is what I've seen the most of over the past 45 to 60 days. That's what I've seen the most calls on in the past 45 to 60 days, just because of where we're at in the market right now. Lastly, I'll wrap up here. Obviously, if you guys have not heard, FHA did come out with some changes due to basically segmenting low credit and high debt to income ratio borrowers. Due to the default rate that HUD is starting to accumulate and notice with defaults on FHA loans, they're starting to segment out with 580, or I'm sorry, probably less than 620 credit with a higher than 50% debt to income ratio. Now, obviously, if you're working with local banks, they don't know they don't understand those loans. Okay, they're 640, 660, less than 45. When you're dealing with mortgage lenders like ourselves, we get those loans. They're 580 and above, 56% debt to income. If it runs through the system, it's an approvable loan. Okay. What FHA has done is they have tightened up the guidelines on those to allow less of those through to try to decrease the default rates. So if you guys are, obviously if you're working with us on those type of loans, we have the knowledge, we have the product, we have the referral sources to be able to get those loans approved, because we make sure everything's done up front. If not, just make sure you're dealing with a lender that understands what an FHA refer file is, because it's hard and fast guidelines, and you can have an approved eligible loan, and if the client made one 30-day late payment in the past 12 months on a mortgage or a car loan, an installment loan, and that file flips to a refer, that deal's dead. There's no exceptions to that, it's dead. So make sure that you guys understand that, and make sure that you guys look at your clients who have those approvals out there, and make sure that their approvals are still valid. Last but not least, obviously, if there's anything, questions you guys have, please feel free to reach out, and if there's anything else that we can do for you guys, we'd be happy to. Thank you so much.